Jerome Powell at the Federal Reserve just dropped a massive bombshell today. The stock market is absolutely mooning on this. The stock market's also mooning on Trump getting elected. So I'm going to play the interview of Jerome Powell right now from what he just did today. We're going to break it down and see, is this stock market rally actually sustainable, or are we in a bubble and we're going to crash? So here's the interview right now, and then we're going to break it down.
The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a quarter percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
So the soft landing that the Fed is trying to pull off is pretty much unheard of if they actually do it. So here's what happened. So inflation started ticking up somewhere around 2020, going all the way up. And you can see right here on the top of the chart, inflation was somewhere around 9.1%. Right now, we're all the way down to 2.4%, but inflation went way up because they were printing money like crazy after the pandemic, and there was all this pent-up demand for people to go out and spend money once the economy opened back up. So there was this huge push of inflation right here, and then check out this chart right here. This is a chart right here of what the federal funds effective interest rate was. So once inflation started coming, the Fed started raising rates to try to combat inflation. So we were pretty much at a 0% interest rate when inflation started to pick up. And you can see all the way up here to the right, this is where the Fed started raising rates. We had a peak of 5.33 for the interest rates. And then the Fed started cutting. So they cut 2 meetings ago. So that took us from 5.3 to 5.1. And they just cut today where that took us to 4.83%. So this is a cutting cycle starting right here. And we are expecting rates to fall roughly 1 more percent to get to that neutral rate. So the question is, how low is the Fed going to go? How much are they going to cut interest rates? So Jerome Powell refers to this as the neutral rate. The neutral rate is basically where the labor market and inflation remains balanced. So right now, Jerome did say that they're not really worried about inflation. I mean, they kind of basically said inflation's conquered without saying it's conquered. And he was putting more of an emphasis on the jobs market and on the labor market. So he's definitely probably going to cut a lot more to bring that more into balance, because right now the fear is jobs, not inflation. So we will probably cut a little bit more. We are going to have a lot more data that comes out before the next Federal Reserve meeting in December. So depending on that data, we will see if we get another 25 basis point cut for this year. So if you punch in the CME Fed Watch tool on Google, you'll come to the website right here. And if you take a look up here on the top, we're going to go to the December 18th of 2024 meeting. So right now, this is our current interest rate range, 4.5 to 4.75. But you could see right here, 4.25 to 4.5. So this is a 25 basis point cut right here. It is a 73.5% chance of that happening right now. Now, like I just said, there is still a lot of information that's going to come out between now and then. So we will see what the Fed is going to do. So let's get back to his interview. We'll break it down a little bit more.
Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures.
So Jerome Powell just said the labor market is currently less tight than what it was before the pandemic. So just let that sink into your head. Before the pandemic, the labor market was pretty much neutral. Right now, it is less tight than that. So less tight actually means that it is a weaker labor market than before. So what that indicates is that more interest rates are probably going to come. They're not really worried about inflation anymore. They're now putting their focus more into the labor market, which means more interest rate cuts are pretty much implied to happen, assuming that the inflation data is going to keep coming in low. Now, in just a second, I'm going to give you a ticker for a stock that if you believe inflation is going to go down, if you believe that interest rates are going to go down, You could make a lot of money on this ticker, so stick around. I'm going to give you that one in just a second. I have a big position on it. Maybe you'll want to make a big position on it too. So let's get back to his interview.
Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time.
A good analogy is, imagine that you're flying in an airplane. Imagine that you're at peak altitude at 40,000 feet. As you do your descent down, that's corresponding to the interest rate cuts. But as you get closer to the airport, you start to smooth out that descent and you come into glide right into the airport. So we're starting to get a little bit closer to the airport right now. So we're going to start to do a little bit slower of interest rate cuts. So maybe at the December meeting, we will get 25 basis points of cuts, but then maybe they'll skip and then they'll do another 25 and then they'll skip and maybe they'll do another 25. And then maybe we'll be close to the neutral rate. But it's all a function of how is the labor market and what is inflation doing. If inflation happens to spike back up, they could stay higher for longer at what we're at right now, or they could even raise interest rates. But if inflation comes in low and even goes below 2%, they'll probably want to cut interest rates a little bit faster than what they're projecting, because then we're going to have the problem of inflation is too low and we're trying to respark the economy to get a little bit of inflation back into the economy. Right around the 2% level is a healthy level of inflation to have.
We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans.
So I just dropped a newsletter that's 100% for free. There's no strings attached. You don't even have to put in your email. So the issue that I just sent out today, we're going to scroll down to the section where I was talking about Jerome Powell and what he did. So let's check out the notes that I wrote on Jay Powell for the Federal Reserve decision today. So I said he appears to be a little bit dovish, which seems pretty obvious. He's basically saying inflation is conquered and they're pretty much going to go cut interest rates. He said that we're still tight on policy, which I do agree with. I think we are. So that implies more cuts. That's what I started here, implies more cuts. And a journalist did ask a really good question. So basically at the last meeting, we got a 50 basis point cut, and you would think that would push bond yields down with it, but bond yields actually went higher. And Jerome Powell was asked this question, like, why is there this disconnect? That's the ticker that I was going to tell you guys about. So TLT will track the price of bonds. So if bond yields go down, bond prices will go up. They move inverse of each other. So check out TLT, do a little bit of research on it, and see if you like it. I personally like TLT. I'm going to add to my position in TLT tomorrow, actually. And then I said right here, this is a Goldilocks situation because we are cutting rates into a solid economy. Imagine if we were cutting rates because we're going into a recession. Yeah, we're going to sit here and say, oh yeah, great, we all got 0% interest rates, but it's going to be like, yeah, we got 0%, but maybe our stock portfolios are way down. So, we want to have a balance of that. We want to cut into a good economy. And honestly, the situation that we're in right now, this is not the norm. Normally we're cutting because we have to cut, but right now we're just cutting because we're just naturally a little bit too tight. So I said right here, they basically said they defeated inflation. He said they're going to carefully cut the neutral. They don't have to cut super fast because the economy is solid. And he also said they don't need and they do not want the labor market to soften anymore to hit the inflation goal. Basically what that means is we're going to probably hit the inflation goal no matter what. So we don't need any more labor market softening in order to get that. We don't need to take from the labor market to make inflation go down. He feels like it's definitely going to go down regardless of that. So this is my alpha report. I just sent out issue number 2. If you want to check this out, I'll put the link below in this video. It's 100% free. You don't even need to put in your email. I went through Arista earnings today. I did my full analysis on that. Potential trades right here. I did the current valuation of the market. Check it out right here. In the tip of the day, we do that, and then I drop my account value right here every day, $875,000. So definitely check this stuff out. And don't forget, if you want to learn how I trade stocks and stock options, how I scaled my portfolio so fast, I just dropped a course. The link for that is in the description below. It's on sale right now. It's a big sale. But if you don't want to get the course, just watch this YouTube video right here. I'm going to break down the basis of how I trade stock options. So I'll see you in that video right there.